Economic slowdown and rising fuel prices are causing high inflation levels never seen in a decade. For example, in Turkey, the inflation rate in the first quarter of 2022 touched 55%, while many countries are seeing a drastic change in the annual inflation rate. Israel, Greece, and Italy saw a 20 times increase in the annual inflation between the first quarter of 2020 and 2022, while the US, Germany, UK, and Canada saw a 5 times increase in the same period. In fact, most Americans today view inflation as the topmost problem. But guess who is in the bottom of this list? China, with almost no change in inflation. Over the last decade, annual inflation in China has been around 2% for most of the time. But for a country that imports the highest crude oil with the largest manufacturing industries in the world, why didn't sanctions on Iran or Venezuela or global economic tensions in general have any significant effect on China's internal economic condition? Smarter handling of foreign sanctions may be one of the answers. Over the last year, the US sanctions on Iran and Venezuela have forced them to provide steep discounts on crude oil purchases to attract the buyers, with Russia joining the list with the Ukraine war. These discounts range from $10 to $22 per barrel against the global Brent crude benchmark, making a very attractive offer for the Chinese oil companies. This is reflected in the crude oil imports of China. Russian, Iranian, and Venezuelan oil together comprise 25% of China's crude oil imports as of 2022. Now, if we calculate the total cost, then on average, China imports about 10 million barrels of oil per day, which amounts to 3.6 billion barrels per year. If 25% of this comes at a discount of $10 per barrel, then this saves China almost $10 billion at the minimum, compared to a country that imports oil based on Brent or West Texas Intermediate, another crude benchmark. In view of discounts and low oil prices in COVID, China filled up its strategic petroleum reserves, which is about 5 million barrels in total capacity. Getting cheap oil is crucial for sustaining China's massive manufacturing industries, which makes from electronics and textiles to automobiles and aircrafts. In fact, the automobile market in China is the largest in the world, with more than 250 million cars and new registrations almost twice of Europe. All these, along with a population of 1.4 billion people, makes enormous oil consumption a no surprise. Plus, China has the second largest oil refineries after the US. This helps to export refined petroleum to nearby countries like South Korea, Myanmar, and Singapore, another good way of making money using discounted crude oil. But how does China avoid secondary sanctions that threatens trading with sanctioned countries? Let's take the example of Venezuela. In January 2019, the US imposed sanctions on Venezuelan oil companies to prevent its president, Nicolas Maduro, from exploiting Venezuela's assets. Following this, the US refineries stopped buying Venezuelan crude oil. But in August, Washington tightened these sanctions, warning that any foreign country that continues business with the Venezuelan government will find itself subject to sanctions. The state-owned China National Petroleum Corporation, known as CNPC, stopped loading oil at Venezuelan ports that month. China's official import data showed a slowdown in oil purchases and came to a complete halt by late 2019. But in reality, crude from Venezuela kept arriving at Chinese ports through a Switzerland-based unit of Rosneft, Russia's state-owned oil company. A roundabout delivery made it appear as if the oil's origin was Malaysia. Allegations of ship-to-ship transfer to mask the true origin of oil were made on Rosneft, which was later sanctioned by the US. Ship-to-ship transfers were also used by Iran to ship oil to China for several years due to sanctions from the US. In some cases, these ships were rebranded as oil from Oman, the UAE, and Malaysia. There is another important reason that prevents China from direct foreign sanctions: the sheer manufacturing prowess and the great control over global supply chains. A simple example of this is the massive supply delays on semiconductor-related goods due to lockdowns in Wuhan and Shanghai. Sanctioning China will immediately disrupt global supply chains and will send consumer prices soaring around the world. In retaliation, the loss of Chinese markets would shave chunks of sales off the Western companies, ranging from Apple to BMW to the luxury brands of France and Italy. Attempts to restrict the Chinese access to the dollar networks might spell the end of dollar as dominant currency for international payments. The digital Chinese yuan will get a dominant presence, which otherwise will take years to acquire. Dozens of countries in Africa and Latin America will resist attempts of an economic boycott of China since Chinese destinations become the main export markets for these regions. In fact, the US and many of its allies like Australia export 40% and South Korea with 25% to the Chinese markets. This completes the discussion on how sanctions help China in economic growth. All references used in making this video are mentioned in the description. Please refer to them for more information.